The Federal Reserve is expected to announce another quarter of a percentage point rise in its benchmark interest rate today.
With today's action, we have raised interest rates by 4.25 percentage points this year.
As the Fed continues to take steps to bring down inflation, some have asked the question, could the Fed accept higher inflation, say 3% for a period of time?
Interest rate increases and inflation have taken hold of an economy largely expected to decelerate even further later this year. The Fed has aggressively hiked rates over the past year in an attempt to cool red-hot inflation, and next week,
it's hard to maintain economic stability as there are too many variables to take into account. The government's narrative always revolves around stability, that everything is under control. However, the last 12 months were unbearably hard for U.S. consumers. The constant battle with rising inflation has hit the budgets of millions of families. After the pandemic, households had to adapt to new realities that offered them goods and services at significantly higher prices. For instance, U.S. inflation reached a new 40-year high in June of 9.1%. So this is what the U.S. Bureau of Labor Statistics report looked like in June 2022. The cost of food has increased by 10.4% in the last 12 months, the most significant increase since February 1981. Food prices at home have increased by 12.2% within the previous year, the highest increase since April 1979. Additionally, food prices outside have risen by 7.7%, the most considerable yearly change since November 1981. Energy prices have also increased by 41.6% over the last year, which is the largest increase since April 1980. However, to fight high inflation, Federal Reserve has been hiking interest rates, hoping it will ease consumer prices rising even more. Fortunately, months later, the situation has not changed on a broad scale, which means that Fed's policy is ruining the economy. So in this video, we're going to talk about how Fed is crushing the economy. But before jumping to analysis, consider subscribing to the channel and hitting the notification bell. That way, you'll never miss an upload. First, let's rewind Federal Reserve over a year's endeavor to calm inflation. In March 2022, the Federal Open Market Committee announced that it would increase its benchmark interest rate by 25 basis points after keeping it at zero since the start of the COVID pandemic. This was a decisive moment for the economy, as it was in 2018 when the Fed hiked interest rates last time. As a result, the rate increased from 0.25% and 0.5%. Fed officials rightly predicted that this increase would cause a rise in the prime rate, resulting in higher financing costs for various consumer borrowing and credit types. In addition, Federal Reserve officials have stated that the rate increases will coincide with a decrease in economic growth this year. However, the Fed officials wrongly predicted the number of hikes it would take to tackle inflation. Then they thought 6 hikes would be enough to tame inflation to desired 2% point. But we now know they were completely wrong. As recently, Fed raised interest rates for the 10th time in a row to a range between 5% and 5.25%, the highest level since 2007. Plus, according to the Labor Department data for March, yearly inflation is 5%, 2.5 times more than the Fed's target of 2%. Moreover, the chart clearly shows that prices of food keep rising, almost 9% compared to last year. In addition, electricity is 10% more expensive, and rent is up 8.8%. Thus, nothing has changed for millions of households, and they still have to pay high prices for basic needs. So far, the Fed has failed to ease consumer prices, but already Jerome Powell hinted that this is the last interest rate hike. From an average household point of view, it's hardly believable. What we have observed so far is Fed destroys the consumer economy and banking system and puts the country into recession. According to Bankrate's chief financial analyst Greg McBride, interest rates are used by the Federal Reserve to control inflation and slow down the economy. The Fed has recently raised interest rates at a record pace, which may result in bank failures and potentially lead to an economic slowdown or recession as the cost of controlling inflation. So the first victim of the Fed's policy is an average consumer. Although inflation officially eased already in November 2022, spending by U.S. households and businesses stalled, according to Financial Times. However, in March of the current year, KPMG's report showed that retail sales plunged by 1%. Sales in March saw a decline across various categories. Most significant decline was in gasoline station sales, dropping by 5.5%, even more than the 4.6% drop in pump prices. Sales of motor vehicles and parts also fell by 1.6%, corresponding with the lower unit selling rate reported earlier in the month. Vehicle producers are struggling to meet the pent-up demand as affordability remains a challenge. Financing rates are increasing while loan duration is decreasing, resulting in some vehicles costing as much as a mortgage payment. Furniture store sales also fell by 1.2%, reflecting the slowdown in spending associated with the housing recession and remodeling activity. In addition, the decline in general merchandise store sales by 3% and department store sales by 2.5% indicates that consumers are becoming more cautious with their spending. Discretionary spending categories such as electronics and clothing also saw a decline, with a drop of 2.1% and 1.7% respectively. Furthermore, according to Fitch Ratings, Fed's aggressive policy will worsen consumer spending in 2023. Fitch Ratings expects U.S. consumer spending to slow to just 0.2% in 2023 from a healthy 2.8% in 2022, reflecting monetary tightening's lagged effect on demand and higher inflation's ongoing drag on real incomes. The recent Consumer Confidence Survey shows that the U.S. consumer confidence declined in April to 101.3 from 104 in March. Finally, the PricewaterhouseCoopers survey revealed that consumers are incredibly concerned when spending money on a global scale as well. Almost 70% of consumers hold back on non-essential spending as the cost of living rises, and 9 out of 10 consumers adopt cost-saving behaviors. If consumer spending continues to drop, it will destroy not only America, but the world economy as well, as consumers buying goods and services is the real driver of economic activity. As mentioned earlier, Fed Reserve's policy has affected the banking system, which might ruin the economy again. The problem is that banks have to sell government bonds in case a significant number of clients decide to withdraw their money. However, when interest rates are high, government bonds at the disposal of banks devalue, and a bank might simply not have enough money to cover withdrawal demand, which is what happened in the case of Silicon Valley Bank and Signature Bank this year. SVB faced a challenge when depositors began withdrawing their funds, causing the value of the securities to decrease. To make up for the shortfall, SVB needed to raise capital. However, the loss was significant and caused concern among depositors, making it difficult for SVB to raise the necessary funds. As a result, a rapid run occurred and the bank collapsed, causing the largest financial crisis since 2008. However, it can grow into an even bigger economic crisis. According to the study, 186 banks in America can collapse like SVB because they run the majority of their capital uninsured, and high interest rates will prevent them from accumulating enough money to cover clients' withdrawal rates. Finally, Fed's hike policy can drive America's economy to recession. A study finds that high interest rates and persistent inflation will likely cause a recession. According to the paper, the Federal Reserve usually responds by raising interest rates when there's a significant increase in inflation, as we've experienced over the past 2 years. This is done in an attempt to reduce economic activity and control price increases. However, this increase in interest rates can make borrowing more expensive for mortgages, auto loans, credit cards, and business lending. In some cases, even higher interest rates may be necessary to manage persistent inflation pressures. Fortunately, this could lead to more expensive loans, resulting in companies slowing their activity or even completely halting new projects and cutting jobs. With consumers reducing their spending, ultimately, this can lead to a recession. Although we might hope that recession could be avoided, data shows that it is almost inevitable. For example, already by the end of 2022, economists were predicting that there is a 70% chance of the country diving into recession within 1 year. However, the Conference Board's probability model estimates that America's economy will plunge into recession in the next 12 months with a 99% certainty. Moreover, in the first quarter of 2023, the U.S. economy grew by only 1.1%, showing a trend of severe decline from the third and fourth quarters of 2022. JP Morgan's Economic Outlook 2023 reiterated that the U.S. could enter a mild recession by the end of next year as a higher interest rates slow demand for goods, services, and the workers to produce them. The severity of the situation is undeniable. Fed's interest rate hikes have done more harm than good, as even Federal Reserve economists said they believe that recent banking turmoil will trigger a mild recession later this year. Thank you for watching. Hit the like button if you enjoyed the video, and let us know what you think about the topic in the comments section below.